AT&T stock offers passive income investors a dividend yield close to 4.2%. Does that make AT&T stock a buy? Not necessarily. I think dividend stock investors need to look at more than just the dividend yield, because when you invest in a dividend stock, you're also exposed to the change in stock price. And that change in stock price could more than offset what you get in your dividend yield. So that's what I'll do in this video. I'll evaluate AT&T on broader metrics besides the dividend yield. Of course, we'll look at the dividend yield, but we'll also look at the revenue growth history, profit margin history, the returns on investor capital, and the valuation measuring by the forward price to earnings and price to free cash flow ratio. I'll also share with you my proprietary discounted cash flow valuation model that highlights what is the fair value of AT&T stock, and I'll finally disclose whether I think AT&T stock is a buy at current prices. So let's jump in. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So AT&T's revenue growth history over the last decade has been volatile. Some of that has to do with acquisitions and divestitures. Overall, AT&T operates in a mature industry with relatively little growth prospects. AT&T's growth is going to have to come from incremental revenue drivers like adding additional devices to people's wireless data plans, maybe adding a tablet onto the smartphone plan, or maybe increasing the price per month that people pay on their data plan. Other than that, the number of people that will look for a data plan are not likely to increase in the markets that AT&T operates in. So revenue growth is likely to be muted, and investors in AT&T stock will be happy if AT&T can manage low single-digit to mid-single-digit revenue growth over the next decade. Dividend yield was much higher in 2024. There were times when AT&T's stock was yielding a dividend close to 7%. And since then, that dividend yield has fallen, most notably because of the increase in stock price. When a stock price increases, the dividend yield falls, because to get the dividend yield, you take the dividend per share and you divide that by the market price. So when the market price goes up, it offers a lower dividend yield. AT&T at 4.16% dividend yield is still one of the better dividend yielding stocks in the market when you measure only by the dividend yield. AT&T's operating margin over a trailing 12-month period has been improving over the last decade as the company has divested underperforming businesses, and now the operating margin reached 19.72%. In addition to divesting unprofitable segments, AT&T also is reaping the benefits from successful investments in 5G technology. That's paying off in a higher operating profit margin. At 20%, the operating margin is solid. And one of these benefits from this operating margin is that AT&T can use this cash flow generated from its operating profits to pay down some of its massive debt load. AT&T is one of the most indebted companies in the world right now. I talked about AT&T being one of the most indebted companies. Right now, it has over $123 billion in long-term debt. That's a massive debt load. Now, the company generates sufficient cash flow to pay its debt obligations. Still, as an investor, you'd prefer a company not have this much debt. But if any company should have large amounts of debt, it should be companies like AT&T that has a strong recurring cash flow base that it can utilize to pay off its debt. And the reason why I say it's a strong recurring cash flow base is that people are not likely to cancel their data plans, their cell phone plans in any economic environment. Even if there's a severe recession, people are unlikely to cancel their data plans, because that's one of the most important things you need is your data plan. People don't really have household phones anymore. Most households have the wireless phones, and that's what they use for communication. That's what they use to stay connected. Maybe they use it for job opportunities. They use it to connect with their kids and family and friends. So that's unlikely to get canceled when you lose your job, especially if you consider the amount of dollars per month you pay for your data plan compared to your overall household expenses. It's not a large percentage of your outlay, so it's not likely to get cut in the event of a recession. AT&T's returns on investor capital are not very good at 4.37%. They are below the company's weighted average cost of capital. The weighted average cost of capital I calculated for AT&T, and I do this when I do my proprietary discounted cash flow valuation models, which you see here for AT&T. If you want access to these videos where I talk in detail about the discounted cash flow, you can get access to these videos if you join my channel as a member. AT&T's weighted average cost of capital is 7.85%, above the return on investor capital, so that's not good. And then the intrinsic value I calculated for AT&T stock was $21 a share. It's currently trading at $26.69. So it looks overvalued when looking at it based on my discounted cash flow valuation model. And when we look at it on a price to free cash flow and price to earnings basis of 10.39 and 11.85, it's the most expensive this stock has been going back 1 year and going back several years. This stock doesn't usually trade in the double digits in these valuation metrics because of all the reasons I highlighted earlier. Very low growth prospects, poor returns on investor capital, large levels of debt. And so this is unattractive for businesses, and that's why they don't trade at high valuations when they have those characteristics. So to answer the question, is AT&T stock a buy for dividend stock investors? I would say no. I would rate this stock as a hold right now at current prices. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.